Welcome back to another Advance Your Wealth episode with Homer Smith. I am your host today and moderator, Eric Daniels, a private wealth advisor with the Convergent team. I'm also happy to welcome our special guest, Joseph Sikora, a chartered financial analyst with Aptus Capital Advisors. All right, so let's just jump right into this, Joseph. Talk to me a little bit about what drove such a strong rally in 2023 and even into December, right? It was a pretty historic year overall.
Yeah, sure. So if you think about sentiment going into 2023, so think about November, December of 2022, almost everyone was negative. The odds on prediction for a recession was, I think the highest of all time outside of an actual recession being in the middle of one. So you had everyone positioned for the fact that things were going to go bad. And the fact of the matter is things did not go bad. You had unemployment continue to stay resilient. You had consumer spending continue to stay resilient, and you saw their net worth actually kind of drive the ability to continue to spend. You had sentiment growth throughout the year where people can eventually kind of bought into the fact that, hey, things aren't as bad as maybe we thought, and we need to reposition into risk assets. And that really happened in earnest in the fourth quarter when the messaging from the Fed came that, hey, that we actually do intend to cut rates in 2024. And that was, you could argue, kind of the main driver that really took things higher into this year. If you look at the data that we're seeing currently, it's really more of the same. Just kind of look at some of the indicators here. Retail sales came back this morning at up 0.6% versus expectations of 0.4. We had the non-farm payrolls come back a couple weeks ago. They beat expectations. Employment continues to stay strong there. Probably the one spot you've seen some concern continues to be manufacturing, where if you look at those surveys, there's weakness there. But pretty much everywhere else, we continue to get strength, and probably plays a little bit more into the idea of, instead of this soft landing narrative that we hear all over the news, kind of the idea that we're going to bring inflation down with slowing, though not recessionary growth. We're almost seeing more of a no landing situation where, yes, inflation's come down, but growth continues, and economic resilience is kind of the theme we're seeing right now. So that's sort of what carried us into 2023, and here we are now.
Yeah, it's really interesting when, as investors, and we're looking at all this data as it comes in, and traditionally seeing that would be very positive for markets, and it has been, but there have been distinct periods throughout 2023 where we get very positive economic data to the upside, and we're getting very strong market moves to the downside, whether that be in interest rates or in the markets. Looking at 2024, how are you actually looking at economic data? Can we still look at it as strong economic data is a positive thing, or do we want to start to see some of that tail off? Because the Fed is looking at that data as well.
Sure. Yeah. So I think that dovetails too into a point that we've made several times on this show, and I was going to kind of discuss again today, is that whenever economic data, when bad news is viewed as good news, or the opposite, it typically correlates with what people think the Fed will do. So interest rates right now are at a level that the Fed is deeming to be restrictive, sufficient to bring inflation down. So right now, inflation is viewed as counter-cyclical. Inflation going up right now is a bad thing. If you look at the last 10, 15 years, when we were almost in a deflationary type of period, news on inflation going up was not viewed as a negative thing. And that's important for how economic data is viewed, but also how interest rates interact with equities. So if you think kind of about the hallmark positioning of a portfolio, is typically a combination of equities and bonds. And we think about the 60% equity, 40% bond portfolio is sort of the key benchmark when you think about portfolio analytics and what we're comparing our returns against. Well, that portfolio composition is really predicated on the idea that bonds and stocks move opposite to each other. That is true in periods where inflation is viewed as counter-cyclical, but in periods where inflation is not a good thing, where inflation is actually something that we're actively trying to fight against, that historically, that relationship between stocks and bonds has changed. If you look back at the 70s, that was the case. On into the 80s, it really was into the 90s where Greenspan kind of got inflation under control, and it stayed there for the last 20 years, that relationship changed. Well, we're now at a period where we're not seeing 6 months of data of this. We're actually seeing a rolling 3-year average of the stock bond correlation turn positive for the first time in roughly 20 years. This is significant for how portfolios are composed. And it's significant. Again, the question you asked was, is economic data good or bad? Good should be good, bad should be bad. But in this instance now, where good can sometimes be bad, what that means is that if data is coming back strong, it means that inflation is likely to kind of pick up. The Fed's going to have to fight that. And again, you go back to that relationship between stocks and bonds. So this is important. It's something we're monitoring closely. And I think it's something here, Convergent, that we are mindful of in terms of how we are making up our portfolios, leaning on option-based strategies and the idea of volatility in a portfolio in order to be that hedging mechanism that bonds have really served as the primary driver of the last 20 years.
Yeah. Yeah. I think that's a very, very interesting point that, because we did see that volatility happen in 2022, but that 3-year moving average ticking positive for the first time in 20 years is really big, not only just for portfolio construction in the short term, but we look at pension funds, insurance companies, most investors, they have bonds in their portfolio to hedge against that equity risk. And if that paradigm has shifted, or maybe that's no longer going to be the case kind of moving forward, having other solutions in the portfolio is important. And so, yeah, that was really insightful to bring that up, because I think at this point, investors are looking at stocks as one asset, or I would say maybe investors are looking at not a stock and bond mix, but either choosing bonds as an asset class or choosing stocks, having it be a choice, not a complement. Is that kind of what you're seeing as well?
Well, I think bonds are still going to be, if you're, especially if you're older individual or in your retirement years, if you're leaning upon your portfolio in order to create income for retirement as a source of means for your life, of course, we don't think you throw bonds completely out the window. It's just, instead of owning maybe perhaps the allocation that you would have in the past, we're composing portfolios that are using less bonds and then adding kind of a hedging aspect through option-based strategies in order to take care of more of that risk component. So you still can lean on bonds for income, although in an environment where inflation is running higher than we would like, a fixed income stream is not exactly the thing you want to have. Nevertheless, we don't see them as completely being useless. We're just allocating less there. We think we can drive more total return by allocating more to equities, less to bonds, and then managing that risk differential through option-based strategies.
Yeah, makes sense. All right, kind of jumping into what's been all over the headlines in December as the Fed kind of made a little bit of a shift, or they had all the reasons to come out and kind of backstop and say that they're still being aggressive, still there's still uncertainty around the rate cuts, and then they almost flipped the narrative, and almost immediately rate cuts are now priced into March, and then throughout the rest of the year. What are you seeing beyond the headlines? What would make that true, and what are the other things that could potentially throw cold water on that scenario?
Yeah. So if you think about during COVID and the panic that ensued there, really 3 things happened. The Fed cut rates to 0. They started buying bonds on their balance sheet, which essentially serves to lower interest rates even further. And then the fiscal government stepped in and dumped a lot of stimulus on the market. So you had this multi-pronged approach, which served to fuel inflation and then also lead to this huge rally in risk assets through 2020 and then into 2021. Of course, since then, Fed's been trying to walk all that back in order to get inflation tamed. So they've risen interest rates to the tune of 5.5%. They have let their balance sheet start to roll off, so essentially reducing the size of their balance sheet. And now they're at the point where they say, okay, we've got inflation more or less under control. Not exactly their words, but that's what they're messaging. We can start to cut back or ease on our interest rate policy in order to get to a more normalized interest rate regime. And like you said, the market's been in front of this. The market's been expecting this pivot, so-called pivot, for over a year now. If you look back over a year, we were expected to continue to see rate cuts when the Fed actually hiked on into the summer. So it would not be the first time if this ends up not being the case, but the Fed now for the first time is messaging, yeah, we're going to do this. We're going to cut 3 times in 2024. The market's saying they're going to cut 6. If you look back about 2 months ago, like you said, the March meeting for the Fed, 100% chance of a Fed rate cut was priced in. That's now been reduced well under 50% at this point. So the market is starting to walk back some of these rate hike expectations that they got pretty giddy about here a month or two ago. But suffice it to say, if things continue with the current path, the Fed is going to cut rates this year. I think what's less being talked about, though, is the Fed balance sheet, and in part because it's a little bit more difficult to understand. But like I mentioned earlier, part of how you increase liquidity in the system and drive interest rates down is having a non-price discriminant buyer in the Fed using money that's essentially created in order to buy bonds in the open market. So if you have a bid for bonds, that's going to drive interest rates down, which is stimulative to the broader economy. Well, that balance sheet's gotten to the point where it's massive. It peaked out at around $9 trillion. And over the last year plus, the Fed's been letting those maturities roll off and not reinvesting those proceeds in order to bring down the balance sheet, which has done so to the tune of around $1 trillion is what's come off so far. The concern now is that as those bonds roll off and you don't have a bid for all the new issuance out in the market, think about the fact that the federal government is expected to run a $2 trillion deficit this year, even though we're running at sub 4% unemployment. You've got around $8 trillion of maturities coming due this year. You've got a lot of treasury issuance coming due in 2024 is my point. If the Fed's not buying those bonds, if in fact they're letting maturities roll off their balance sheet, then the open market has to absorb all that flow, and typically they do that by drawing down on bank reserves. We saw this in 2009, where bank reserves during quantitative tightening, which is a fancy word for saying the Fed not buying bonds, letting bonds be sold into the open market. We saw that become a concern with bank reserves to where money market rates were growing at a rate that really wasn't sustainable, and the Fed had to step in and inject liquidity into the banking system. I think they're a little bit more alert of that happening this time. There's been academic studies in terms of what bank reserves need to be in order to prevent liquidity panics like that from happening in the future, and we're starting to get closer to where those numbers are. So tying this all back in together, because this is very academic and it's pretty difficult to understand, is the fact that if the Fed has their hand tied in terms of what they can do with their balance sheet, if they can't reduce it to the size that they would otherwise prefer to have it, it may also tie their hands in terms of how many rate cuts they can expect for the near term. Because if you're no longer reducing your balance sheet and you're cutting rates, it's going to have a big stimulus effect on the economy once again. And what you don't want to see is a second round of inflation. We saw it in the 70s. Actually, if you look at developed markets over the last 100 years, and there's been studies done on this, something like 80% of rounds of inflation have a second round of inflation. Feds, they know that, they're well aware of that. So they have to walk this tightrope of wanting to keep unemployment low. They don't want to cause a recession, but at the same time, they do not want to see inflation get out of hand again. And this ties in this dynamic with their balance sheet as well, and how it has an effect on bank reserves. So a lot of moving parts. Luckily, people much smarter than us are in control of this, but at the same time, they're fallible as well. And there could be some movement over the next year as that dynamic plays out.
Yeah. So thank you for explaining that. I know it's pretty in depth and a lot of moving pieces there. And what's talked about in the headlines is where the kind of the nominal rate interest rate is on the short term and what the Fed's controlling there, but rarely what's talked about is what's rolling off of their balance sheet and what they're not buying or what they're putting back, or otherwise taking liquidity out of the market. So thank you for your insights there. Yeah, I feel like the Fed is just in a very precarious spot. Like it has been. You know, the market's front running it. The market's trying to determine what their next move is going to be doing, and so far they've kind of been dictating that, almost. I mean, at the same time, inflation is coming down, and there's a big argument to be made that, you know, inflation in the threes and interest rates at 5.5, we're in a pretty restrictive stance. But that's only one part of the equation. I think also what's not talked about as well, in this context, is all the fiscal spending and fiscal stimulus that's going on. So we almost have these two opposing forces, because the Fed's trying to accomplish one thing, and then the government is doing another. Can you talk a little bit about that, and could that have potentially, along with the strong economic data, kind of boosted 2023, with the spending that happened?
Yeah, if you look at like fiscal deficits as a percentage of GDP, so essentially normalizing a nominal number for inflation, we're kind of in unprecedented territory in terms of the deficit we're expected to run for this year and for last year in relation to where unemployment is. So if you look at the Great Financial Crisis or other big recessions in the past 100 years, or wars, for example, World War II, World War One, instances where the government was really required to spend money in order to prop up the economy in one way or another, or finance conflict. Like I said, you see that kind of deficit as a percentage of GDP explode. Well, where it is right now is, outside of wartime, outside of recession times, is the highest it's ever been. And you look at it in the context of sub 4% unemployment, it's really unprecedented. There's just been this kind of culture of spending at the federal government that continues to increase. And you really saw it, and you can't just blame it on Biden. You saw this with President Trump even before COVID, and really you could consider that wartime spending, you know, with the response that was required in the initial stages of COVID. But we saw this during Trump's administration. We've seen it here. And one thing you can count on in an election year is that the government's going to do whatever they can in order to help get themselves reelected. I mean, that's human nature. So the means by which they can do that is spend money. So you see a tax bill going through, tax cut bill going through Congress right now. You've seen things like the CHIPS Act, the IRA. You've seen all these plans come up that just call for more and more and more spending. And you know, again, there's no coincidence to the fact that there is an election in November and government's trying to make people feel as happy as possible. Will the bill ever come due there? Who knows? I mean, people have been kind of saying this for years and years and years. But one thing it does is that the last 20 years or so, again, we were seeing these deficits. We haven't run a surplus since the Clinton administration, or actually the early Clinton and Bush kind of time frame. So we're talking about 20 years. We've been running pretty large deficits here consecutively. That wasn't as much of a problem in a kind of I wouldn't call it deflationary, but in a non-inflationary period. Now that we're entering this period where inflation is more of a concern, interest rates are higher, the funding cost for the government has gone up, and there's naturally less buyers in the market. Now that you have a lot of the foreign participation waning in compared to where it was 5 or 10 years ago. So it really calls for interest rates, and more specifically, longer term interest rates to increase. The idea that the term premium of owning longer duration bonds, deserving to be done at a higher interest rate, is starting to play itself out. I think more and more you're going to have a situation where I personally think it's tough for the 10-year treasury to get sustainably below something like 4% where it is right now without having some pretty bad economic consequences. So if you see a recession, you're going to see interest rate drop. But if you don't, again, given the amount of the fiscal stimulus, issuance of treasuries, where term premiums are going, I think that it all kind of aligns with interest rates going higher, especially on the back end. It's bad for mortgages. That can be bad for stocks, doesn't necessarily have to be, but it's definitely bad for the government as it kind of becomes a self-fulfilling prophecy as debts go up, interest rates go up, which means your interest expense goes up, which drives up more debt, and that cycle continues.
Yeah. Yeah. So talk to me a little bit about money market and money market, the total amount deposits in money market today. So yes, there are less foreign buyers, and bonds throughout the last 2 years have been unattractive and attractive at times. So we've seen flows move in and out. Could there be a bigger shift from money market funds to treasuries, or to the entire bond market in general? That's a big question that I want to get your answer on, because money market rates right now might be 5.25%, but the 2-year treasury's at like 4.25, right? And so like people today are still making that shift, only looking at what the next month is going to pay them on an annualized rate, but not looking out a few years, or even adding duration to one's portfolio. Give me a little insight on how those, because I think we have 5.5 trillion in money market, right? Like, how does that affect the overall bond market, and maybe even in the stock market?
Yeah, sure. So as short-term rates come down and the curve uninverts, you're naturally going to see money leave money markets. I think the big debate has been, is that dry powder for to go into risk assets, or is that simply bank deposits that came out of zero yielding bank accounts and into money markets yielding over 5%? So if that's the case, then it's not necessarily a buy signal for equities. But if it's the former, where if that money could roll into risk assets, then that's a big bid that would further drive up equity prices at a time when interest rates are coming down. It should be stimulative for risk assets anyway. We won't know that until it plays out, but you're not wrong. As a nominal sum of money, money market flows are extremely large, and it represents a big part of the economy that's going to flesh itself out, over the ensuing months, whatever the case may be. If you look at prior recessionary periods where money markets were used, not only for the higher rates, but also for kind of a flight to safety type of mechanisms. If you look at money market flows as a percentage of stock market cap, so again, normalizing for some form of inflation, we're not to the periods that we saw in the great financial crisis or the dot-com bubble. So just because the nominal level is high doesn't mean on a relative basis it's really that high, but it can't be ignored. It is high. It's higher for normal periods of time, and as rates come down, it's almost has to come down. So the question is just going to be where that money lands, and we just don't know.
Yeah. Okay. So something we'll be watching out for. I know from an advisor perspective, we have a lot of clients that are just moving assets just simply because money markets are paying much more than what B of A is, for example, right? Or
Yep.
other large institutions. And so we do have a mix of that, but then there are a lot of clients that are just flush with cash, so they've been building these deposits. But then the question becomes, well, maybe it starts to make sense at different times to extend that out, because I'm already flush with cash. I don't need this level of deposit.
Yep.
So it's going to be really interesting to see how that plays out, and see if that is a supportive bid or just a liquidity draw. So I want to wrap up today with just looking at earnings season. We're a week into it. Where 2024 expectations are pretty lofty, I would say. I'll let you kind of get into the numbers on that. But yeah, current S&P 500 estimates are pretty up there, just kind of given still the headwinds that are out there. And so I guess give us some insights into those earnings estimates, what to kind of look for in this earnings season, and then what might be the driving force to meet those expectations, or what are some scenarios where we would fall short of those?
Yeah, sure. So I think something like 25 or 30 of the S&P 500 constituents have reported so far. So kind of too early to tell what's going on, but some things to look for. So this is the last reporting quarter for 2023. We're looking forward to 2024 already, of course. So I don't think so much that how numbers come in relative to this quarter matter that much. You typically see a big sandbagging effect coming into the quarter end where companies pre-release and maybe guide down in order just so they can beat expectations when they report, in the subsequent weeks, which is kind of a silly routine, but that's kind of how the game is played. So I don't think this quarter has a big, there's a lot of eyes on it just because the hurdle wasn't very high. But as you get into 2024, the hurdle is really big. So the expectations for earnings growth between 23 and 24 are something like 11%, a very meaningful jump. And that continues to be revised down. So when you think about an equity market that's trading at like 19 times forward earnings, you really need that E in that PE ratio to hold up when you're trading at a ratio that's that high. So if that continues to bleed, that could be a concern. And it seemed like a lot of companies were punting on guidance in third quarter for 2024. So you may start to see guidance for 2024 in this press release for the 4Q 2023 earnings season. I think the eyes are going to be much more on that commentary than it is on what the EPS numbers are for this trailing quarter. They want to see how companies are guiding for this year. And the expectations for 11% earnings increase is not a whole lot on top line revenue. After all, inflation's come down quite a bit and is expected to continue to come down. So how do you have top line growth that's, much more substantial than inflation to begin with? Therefore, if you're going to get earnings growth, you're going to have to get it from better margins, which is increased productivity. Productivity really waned kind of in the slums of 2022. It's picked up since then. A lot of people are excited about AI and that sort of thing in order to enhance productivity. So the onus is going to be on the results to kind of prove that the expectations were correct, and a lot of that's going to be on margins, not on top line growth.
Yeah, and it seems as if, at least in the last few months, there have been a lot of companies that have, lightened up their workforce or lightened up different areas of their business to improve those margins. Do you think that's going to be enough kind of coming into 2024, or is it still too early to tell?
Yeah, so you can cut costs or you can increase productivity. Of course, cutting cost is a measure of increasing productivity, but you can become more efficient with your operation, or you can kind of trim the fat, so to speak. So there have been at the margin some jobs let go. I say that's the margin because it's typically been from businesses that expanded way too fast during COVID. If you look at like a Google, for example, and the amount of employees they added in like an 18-month period, it was just astounding. So if they're going to let go of 5,000-10,000 people in light of how many they gained during that period, it's really not that substantial. So it makes for a big headline. You see jobs cuts from a kind of a bellwether company, but if you put it in perspective of how tight labor markets are, the fact those people can go find a job elsewhere, almost certainly, it's really hasn't had any sort of impact on the economy, hasn't had any sort of impact on equities or a concern about a contagion in the employment front. So that is a way that companies are kind of leaning up a little bit on the margin, but I think it's just becoming more efficient in their operations. That's really how they're expected in order to hit those earnings numbers. And I think a lot of that's expected just through technology, through technological improvements and developments that are making them more efficient at their business, not necessarily cuts on the employment front.
Yeah, and that's probably why we're seeing Microsoft surpass Apple as the largest company in the world, and because they're making headways in that productivity front and what they're doing with partnerships in AI and making their platforms easier to use. So, Joseph, I want to thank you for your time, your expertise as always, and we look forward to having you on another episode.
Yep. See you next month.
Thank you. Bye.